In this week's video, we'll use the observable evidence to show why it's fair to say the markets are still bullish, but correction odds have increased. In last week's video, we said we had not seen enough yet to reduce risk. In this week's video, we'll show you some observable changes that we have seen and the chess moves that we made to stay in line with our discipline system and rules. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. The best way to summarize the changes that we've seen in the last 5 trading days is to look directly at the CCM market model, because that's what it does. It takes numerous inputs and then recommends a prudent exposure to growth assets such as stocks and conservative assets such as cash, bonds, or currencies. If you would have asked us a week ago on Friday, July 18th, what do you think about the market? Our answer could have been something along these lines. I'm 88% confident and 12% concerned. This week, I'm 82% confident and 18% concerned. You'll notice there's nothing in here about being bearish. We're just not as confident as we were a week ago from a probabilistic perspective. What the market model allows us to do next week, if the market continues to deteriorate, we've already established a relatively small position in bonds. It's not all the way up to this number. We took an incremental step towards this number, and we've already reduced risk a little bit this week. If the market continues and is weak next week, we get positive feedback, and if we go into a multi-week or multi-month or multi-year correction / bear market, we will have taken the first incremental step towards building a conservative portfolio. If the stock market rights itself and has a good week next week, we still get positive feedback. Why? 82% of our assets are still in stocks or equities. We'll let the market decide which way we go next week. There are 5 separate submodels that feed into the master CCM market model. They look at the market from different perspectives, use different inputs, and they might use different time frames. One of them is the correlation model. It has multiple charts. I've shown just a handful of them here, but what it does is summarize a lot of data. A week ago, all of these charts, roughly 85% of the questions were returning bullish or favorable answers a week ago. This week it's dropped a little bit. It's still positive at 75, but it shows you observable and unbiased deterioration that has taken place. S&P 500 went from 90 to 84. 84 is still a good number. Stocks versus bonds went from 88 to 77, slipping a little bit in favor of bonds now. The broader NYSE composite went from 75 to a more concerning 64%, meaning roughly 36% of the answers now are coming back bearish or concerning here. The credit markets that we'll look at in a little bit more detail later were weak a week ago, and they continue to be weak. Small caps concerning a week ago and a little bit more concerning this week. Let's look at some of the charts behind these numbers. A fair question might be, Chris, the S&P 500 just made an all-time high this week. How bearish could things be? Well, I want to emphasize again, we didn't say they were bearish. We said about 80 some odd percent of the info and information still looked good. Why we're seeing some deterioration, though? This is a daily chart of the S&P 500. This is the close on Friday, July 25th. You'll notice this horizontal line tells us that we're roughly at the exact same place that we were over 3 weeks ago prior to the July 4th holiday. You can envision that many of your indicators that were relatively strong here may be flattening out just as the market is flattening out, leaving the math and the market more vulnerable here. Vulnerable does not necessarily mean bearish, but if we continue to roll over, you can move from a lot of yes, yes, yes to no, no, no in your model. Instead of getting a 1, you get a 0. We'll keep an open mind heading into next week, but this gives you some idea of why the numbers have been dropping. Shifting gears to market breadth, this is one of the inputs in the model. It really doesn't carry a heavy weight, but we do use it. This shows you the percentage of stocks in the NYSE composite that are currently above their 200-day moving average. If you follow along on Twitter or if you're a client, you remember that we started to scale in a little bit faster on the growth side here as market breadth was improving. This is a full-bore bullish look for the trend on a weekly basis for market breadth. You can see, similar to price, market breadth has been deteriorating now for some time and is still in a full-bore bearish look. It did improve a little bit this week, but really didn't change it. This isn't something to run for the exits. It's just showing you an example of why have the numbers come down a little bit in the last 5 trading days. Where do the highest risk-reward trades come from in a market? They come from places where bullish conviction relative to bearish conviction is high. That's a low-risk trade. An example of conviction, stocks risk-on relative to risk-off treasury bonds. Here in 2013, you can see the conviction to own stocks is much stronger and consistently stronger than the conviction to own defensive treasuries. You can see this is a full-bore bullish look, and we really maintain that for the rest of the calendar year. How does this chart look today? We don't have that type of conviction. Instead of a sharp upward trend showing bullish conviction, we have a consolidation confused market here. The ratio today is at the exact same spot that it was almost 8 months ago in November. 1, 2, 3, 4, 5, 6, 7, 8. We're into the 9th month. This is a low conviction market that makes it harder to identify market leaders. Why do we look like this? Well, the market's confused. It can't decide whether growth is strong enough to offset the Fed tapering, or will the economy not be able to hold its own, and will the Fed decide to reverse the taper or slow the process? This is confusion. Here, notice in mid-May, we said things improved. Like the breadth chart, this chart has deteriorated in favor of TLT. We'll keep an open mind heading into next week, but this is just another example of the deterioration that we've seen. This is another chart used in the CCM market model. This is junk bonds relative to treasuries. When I'm more confident about getting paid back or less concerned about bond defaults, I'd prefer to own higher yielding, riskier junk bonds, and I'll take the yield. When I'm concerned about potential defaults or even a change in interest rates, I may prefer to be in treasuries. Risk on here, remember we said things started to improve in May. They improved here, but like many of the other charts that we've looked at today, it has also deteriorated and now is in favor of TLT relative to JNK. We understand there's a maturity or duration mismatch here. We get that. We're using this for a reason. We also use charts that don't have this mismatch. Before we move to the last set of charts, I just want to emphasize again, what do we see now? We're 82% confident and 18% concerned. This week's video is zeroing in on the 18% concerned for the most part. This number is still relatively favorable, though, and we want to emphasize that. These charts here do a good job of showing us the mixed bag. S&P 500 still has a full-bore bullish look, but We were unable to make a higher high on the weekly chart here. This is a lower high. And if you look at the slopes of the moving averages, they're not as confident in recent weeks as they were here. Stocks relative to a diversified basket of bonds, everything that I just said about this chart applies to this chart. Slopes flat, doesn't look as confident as it did a few weeks ago. The broader NYSE Composite Index, which has more stocks in it than the S&P 500, failed to make a new high here and has somewhat of an indecisive look. None of these charts are disastrous. They're just not as confident as they were a few weeks ago. And therefore, we made a couple of chess moves based upon our firm and disciplined rules to get in line with the present day market profile. If we roll over and deteriorate further, we'll make further incremental chess moves. If these charts can stabilize and right themselves, we still have an 80-some-odd% exposure to stocks, and we're happy to ramp that back up again if and when the evidence improves. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.